Ladies and gentlemen, good day and welcome to the Rupa and Company Limited Q4 FY23 earnings conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nachiket Kare from Orient Capital. Thank you, and over to you.
Hi, good evening everyone. Thanks for joining us on the call today. We are joined by the management of Rupa and Company Limited, represented by Mr. Agarwal, Full-Time Director, and Mr. Sumit, Chief Financial Officer. Before we begin, I just like to give a small disclaimer that this conference call may contain forward-looking statements which are based on the beliefs and opinion as on date of this call. These statements are not the guarantees of future performance and involves risks which are unforeseen and difficult to predict. A detailed disclaimer has been added to the reference presentation which was uploaded on the exchange. I hope everyone had a chance to go through it. With this, I would like to hand over the call to Mr. Vikas Ji. Over to you, sir.
Thank you, Nachiket, and good evening, everybody. I would like to extend a very warm welcome on behalf of Rupa and Company Limited to everyone for joining us on this call today. I hope everyone had an opportunity to go through the financial results and investor presentation which has been uploaded on stock exchange and on our company's website. Well, this year, the year in review has presented a significant challenge for our industry, witnessing steep volatility in raw material prices, which were on an increasing trend at the start of the year, beginning of the year, and then gradually declined steeply by more than 30%. This phenomenon is unprecedented in our industry, which led to restocking at distributor level throughout the year. As a result, the operating margin suffered due to dual impact of high cost raw material and product supply at higher incentives and schemes to the distribution channel pursuant to declining trend in yarn prices. The gross margin for the fiscal year ending financial year 23 stood at 28.6%. Our EBITDA margin was also impacted because of higher marketing cost over previous years and underperformance of thermal and athleisure segments. We anticipated normalization in market sentiment and pickup in demand with the stabilization of yarn prices around rupee 270-280 per kg at the current level. Well, we are actively taking steps to enhance our brand through various marketing activities. Recently, we have onboarded celebrities to promote our premium and economic segment brands, which is John and Macroman. In terms of our revenue breakdown, exports accounted for INR 41 crores, showing 25% stronger year-on-year growth. Modern trade contributed INR 51 crores, also exhibiting a 32% year-on-year increase growth. Overall, we generated INR 111.42 crores in revenue during financial year 23. This growth demonstrates our ability to seize opportunities in the evolving modern trade channel, where we have done quite good. During the quarter, we successfully launched 2 exclusive brand outlet stores. The total EBO count currently stands at 28 stores. We will continue expanding our presence in retail landscape to give our retail customers, especially youth, wholesome purchasing experience. Despite the challenges we faced, we maintained positive cash flow of INR 185 crores and efficiently managed working capital deployed in business. The same resulted in significant reduction of overall net debt position. Board of our company, keeping the tradition of sharing profit with shareholders, has proposed to maintain dividend at 300%. Looking ahead, we anticipate improvements in margin for financial year 24 as the market sentiments normalize and the effects of the underperforming segments diminish. We remain focused on optimizing our operational efficiency, managing cost, and leveraging growth opportunities to enhance shareholder value. Regarding current year performance, management stand by the performance because of very unique situation, and we are quite hopeful in coming 3 years we'll be clocking a turnover of 2,000 crores. With this, I request Mr. Sumit Khawala, our CFO, to give you update on the financials, please. Over to you, Sumit.
Thank you, Vikas sir, and good evening, everyone. I will proceed to provide a brief update on the financial performance. The revenue from the operations for the quarter 4 FY23 is 407 crores, down by 10.9% compared to corresponding quarter last year. As mentioned by Vikas sir, the headwinds in the industry have affected our margins. The gross margin for the quarter is 23.5% vis-a-vis 34.3% for corresponding quarter last year. The EBITDA margin stood at 6.7% in quarter 4 FY23 as compared to 16.2% in quarter 4 FY22. PAT is at 5.5 crores with a PAT margin of 4.6%. For FY23, revenue stood at 1143 crores and is down by 22% year on year. Gross margin stands at 28.6% versus 34.8% last year. The EBITDA for the year is 89 crores and the EBITDA margin is 7.8%. PAT stands at 54 crores with a PAT margin of 4.7%. A multitude of factors have led down in sales, resulting in degrowth across key metrics. However, our prudent financial practices have ensured that we are able to free up working capital and cut down our net debt significantly. Net debt for the year FY23 is 134 crores vis-a-vis 231 crores last year. Net working capital deployed in the business is reduced to 789 crores from 910 crores for FY23. We have significantly improved our cash from operations from net outflow of 116 crores to the positive cash flow of 185 crores this year. Thank you for your attention. We are now happy to take questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Keshav Garg from Counter Cyclical PMS. Please go ahead.
Sir, I'm trying to understand that you mentioned that we want to double our revenue over the next 3 years. So if we do so, then sir, our growth from FY22 to FY26, this 4-year period will come to around 7.9% only, which is more or less equal to the inflation rate in the country. Sir, so what I'm trying to say that, sir, don't you think that it's a conservative guidance?
Conservative guidance, like next 3 years we are saying 2,000 crores with a base of 1,140 crores. So does it come 7.9%?
No, sir. Sir, I'm taking it from FY22 base of around 1474 crores. So over the next 4 years.
Absolutely. So this is the minimum what we think, but will all depend, and we want to, and I don't want to overcommit. But with the current year, we at least want to grow by 25-30%. So once we have that growth, of course, we'll review these numbers again. But this coming year is quite crucial, very important for us, where we are putting all the efforts. And once we have a strong base growth this year, I'm sure those numbers what you're talking will definitely improve from those levels.
Sir, also, sir, you think in your judgment as things stand today that we will be able to reach, if we grow at around 25-30%, then we will reach FY22 top line in this year itself. Sir, but as far as the margins are concerned, sir, you think that we will be able to reach around 18% operating margins that we did in FY22?
So margins are difficult. Right now, our understanding is we don't want to lose market share. And we are investing heavily on the advertisement and brand pool. We have invested more than 3-4 celebrities. And when our EBITDA margin was 18%, that year our marketing spend was 4%, which was much below our average. So this year it will come back to 7-7.5%. So we are hopeful I don't know. I'm not sure about immediate quarters because a lot will depend upon how the yarn prices behave. But for this whole annual basis, I think we should be able to clock 11 to 12% EBITDA margin minimum. These are sense what we'll be able to achieve.
Sure, sir. And sir, what kind of capex are we looking at?
What kind of?
Capex.
Capex is what we'll do roughly 20-25 crores year is our annual budget.
Okay, sir. Thank you very much and best of luck.
Yeah, thank you.
Thank you. We have our next question from the line of Shikha Mehta from Equity Capital. Please go ahead.
Hello, sir. I just have a couple of questions. As you mentioned in your opening statement as well, cotton and hence yarn has sort of normalized now. But in spite of that, our gross margins this quarter took a beating. Is that because we had high cost inventory on our book? Is that the right way to look at it?
Yes, ma'am. To large extent, yes.
So is the high cost inventory factor completely done away with now, or are we still carrying some high cost inventory?
I think in coming quarters, maybe one more quarter, we'll be able to, 1 or 2 quarters max, things will average out.
Okay, so maybe the first half of the year should still see some impact of this.
A little soft, yes, ma'am. And that's why we are giving a forecast of 11 to 12% EBITDA margin, keeping everything in mind.
Okay, got it. And so can you give me the ad spend figure for this quarter?
7%.
Okay, and that is what we're expecting
Ad
for
spend
FY24.
for quarter for FY23 is 6 point,
Roughly 7%.
37.
Okay, no issues. So could you also help me understand how our credit terms have been for the quarter and for the year? I think in Q3 we said that we didn't want to let go of market share, so we were kind of loosening the credit term. How has it been for the quarter?
Data is compared to like our data is to get 425 crores compared to 540 crores last quarter 4 of last year.
Okay, right. And sir, another thing I wanted to understand from you is if you can shed some light on the channel inventory levels and whether we're seeing restocking happening now.
Yeah, we are seeing we are dealing in the products which are essential in nature. Currently we are seeing that there is an uptick in demand. So we think we'll maintain a same inventory level going forward.
We don't see any different because these are essential, so we have to maintain inventory. Because of the falling cotton prices, there was a negativity in the market. Because of some steep, it's more than 30% steep fall, which is unprecedented. Historically, it's never happened. So the silver lining is probably dealers and they don't have much stock inventory with them. Once they are confident about the yarn stabilization, I think the market should pick up.
Okay, sir, got it. Can you also help me with the growth numbers in the mass segment, the medium segment, the premium segment, and in women?
Yeah.
Means the overall.
For FY23, yes. In mass, in the medium and premium, and in women.
Okay. The overall price degrowth is 5 to 6%, and the volume degrowth is around 15-16%. Okay, and if we talk about economic segments, the price degrowth is 5%. Mid premium segment it is 7%, and premium segment it's around 4 to 5%.
Okay, fine, got it. This is on the price, right? And on the volume side, or this is overall?
It's on the price side. For economy segment, volume degrowth is 15% around. For mid premium segment, it's around 16%. Premium segment is
around 20%.
Around 20%.
Okay, sir. And same thing for women?
Women segment means largely means.
Yes, roughly the same, man. What we have the mid premium.
Okay. Got it. And also, how is summer shaping up for us currently? How has Q1 been so far?
Q1, we are quite hopeful things should do well. We are investing heavily on the brand pool and all. We never advertise for our economy brand, which is John. So we have recently taken 2 brand ambassadors. One is Ranbir Kapoor, and other is a local hero of East. So we are quite hopeful with the kind of brand pool we are creating and the kind of schemes we are giving the market. Q1 should do decent for us.
And apart from the price correction we've seen so far, do we expect more price correction going forward, considering the raw material prices are stabilizing?
It will depend upon the yarn prices. If yarn prices start increasing, we'll increase rates. So if it stays at this level, our prices will stay for a quarter at these levels, but gradually it should increase on a yearly basis by 3 to 5%.
Okay.
It will all depend upon the yarn prices, so it's very difficult to comment anything at the moment.
Okay, fine. Thank you. I'll come back in the queue.
A lot depends upon the foreign, what is happening globally on the cotton prices. So.
Okay, got it.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We have our next question from the line of Resha Mehta from Green Edge Wealth Services. Please go ahead.
Yeah, thank you. So my first question is on the working capital. So it used to be in the 45 to 50% of net sales range, and in the last year it has shot up to around 70%. Perhaps the extended credit cycle contributing to this. So one, how quickly do we see this, reverting back to the old levels of 45-50%? And second, what is your desirable optimum working capital that you all are targeting, and what steps you all are taking to kind of get there?
And this year, net working capital deployed in the business is reduced to 789 crores from 910 crores. So this time the turnover is a little bit lower, so working capital days are looking at on a higher side. But ideally, means we feel that 150-160 day net working capital would be ideal for the industry, for our company.
Once we achieve the given growth top line, it will automatically fall in the right numbers, 150-60 what we use.
Okay, so that would still be roughly 40% of net sales, right?
Yes.
Okay. And do you see this going back to 40% levels in FY24?
Yeah.
Yeah, we are quite hopeful.
Okay, and will be led by reduction in debtor days or inventory days or both?
Both, and we have the new software SAP HANA in place. So operationally, our efficiency should be better and all. It will help us to do proper planning and proper control also. So we have recently implemented the AFS model in this April last month. So things should do better.
So related question here. So, you do have distributor management system, right? So this has been implemented across how many of your 1,500 dealers?
No, right now I was talking about the AFS SAP HANA model. So now we are talking about the DMS model. For DMS we are trying, we have hardly 70-80 distributors, but we recently hired an agency now, which is on the board. They should help us to extend this to a large number of distributors. So how to focus on the retail and have a more clear visibility on the secondary, we have just hired with the agency now, and that should help us to have a better control on the marketing visibility.
So if I were to understand this a little bit more, so basically you have 70-80 distributors who in turn supply maybe to 1,500 dealers or to retailers directly. Is that the correct way to look at it?
No, we supply to distributors, 70-80 distributors, and they supply to retailers, their retailers.
Okay, so the presentation mentions around 1,500 dealers. So
1,500, 1,200 is our total size of distributors we have in India. Out of that, wherever DMS is implemented is around 70-80 dealers, which is 5% of the total dealer universe we have.
Right. Okay. So basically, we have direct visibility and the tracking is possible only for our primary sales as on today, right? What we sell to these 70, 80 dealers, correct?
Yeah.
Right. And is it...
We have a primary visibility of all 1,200 dealers and what we have, but secondary visibility of 70, 80 dealers wherever we have DMS is there.
Okay. Got it. And how big would, Fruit of the Loom and this FCUK brand, how big would these brands be in terms of size? What revenues would they have done in FY23?
The size is not enough, like as updated on our previous calls also, like after the COVID years, before that the brands were doing very good and we invested heavily on these two brands. But after the COVID, levels were all shut and all, so there's a big drop in the top line of the brands. And for us to revive the brands again, we have to invest heavily again, which at the moment we are not very keen with, management is not keen with. So whatever organic growth they have from our EBOs and from online, we are pushing more of that than investing the brand into general trade duty.
And otherwise, we have an exclusive license, right, for these two brands?
Yeah.
And pre-COVID, what was the revenue number for both of these brands?
Around 43 crores.
Sorry, around?
Around 40 crores.
Both put together?
Yes, ma'am.
Okay. And can you talk about your revenue split between urban and rural, if you all bifurcated that way?
As I said, we have more of a primary numbers with us, so our understanding is 50-50%. So we don't have, because a lot depends upon the secondary again. So primary wise, it's roughly 50% each, 50% primary and rural, 50% urban.
Got it. And I think the presentation also mentioned about, drop in realization. So is that, through reduction in MRPs or we've passed on as discounts to channel partners?
We usually pass on the discount.
So there's no reduction in MRPs, right, that we've taken?
So there was a reduction in MRP as well because there was a steep fall in yarn prices, so in our schemes also. So we have reduced the prices also around March, April. But that doesn't matter, that doesn't affect us a lot because our products are not selling much on MRP and the fluctuation between the net WSP and the MRP was quite high. So it was demand from the trade because of the corrected prices, they wanted to reduce the MRP, which we have done in sync with the increased benefits what we have given to the distributors.
Right. And lastly, if you could talk about how is the demand shaping up, demand outlook. I'm sorry I missed your opening remarks in case if you have already mentioned back then.
As you know, I think last year, or last 2-3 years, we were little soft on the marketing side and all, on our economy segment where we have a big turnover. So this year the idea is we don't want to lose on the market share, we want to increase the market share. So spending large on the marketing part, and this will surely take care of the top line. We might compromise on the bottom line for a few quarters, but for long term, I think should be healthy. Should be much better numbers what we have today.
All right. And what would be your revenue contribution from athleisure and thermal wear for both FY22 and FY23? Just as a percentage of revenues, if you could tell me.
Percentage of revenues was quite less this year from COVID years, both athleisure and the winter wear and thermal wear. Largely because the demand was less, so we took a big hit on our margins also because these two range contribute a lot to the top to the bottom line where the margins are quite high.
5% and thermal 5%. Contribution from athleisure wear is revenue contribution from our athleisure wear segment is 8% and from thermal wear it's 5%.
This is for FY23?
Yeah.
Okay. And how high what would be the margin differential between, let's say, a company average versus athleisure and thermal wear, which are higher margin?
At least 5 to 7%.
5 to 7% at the gross margin level, right?
Yeah.
Okay. All right. Thank you. All the best.
Thank you.
Thank you. We have our next question from the line of Rohit Ohri from Progressive Shares. Please go ahead.
Hi, Vikasji. A couple of questions. The first one being on the growth CapEx plan that we had. We were looking for some dedicated export unit in Domju, probably an investment of 18 crores and the cutting unit of around 18-20 crores. So by when do you think will this be commissioned?
It's already commissioned. Will start this year.
Yeah.
Cutting unit is already commissioned. It started. Gradually, it will be in full capacity next coming quarters, coming months.
And export unit is more or less ready. We will be commissioning in the month of May, in May 23.
June. May is already gone, so June we should be able to.
That's right. Okay. Great. Because you were talking about a CAGR growth of around 20% or so, while at the same time we are saying that there is softness in the market. So what gives us this confidence that we will try and get that 20% CAGR growth over the next 4 or 5 years to achieve the target of 2,000 crore?
At the end of the day, we have to survive. So with this disappointing result, where we are extremely ourselves dissatisfied. So a lot of lending, what we did last year, and last year we took hit a lot knowingly to have a control on the credit policy, to have a healthy credit policy for long term and few other reasons. But on the lower base, we have to grow at least 25-30%. And we have taken a lot of initiatives in terms of marketing, in terms of scheme penetration and all. We are sure 25-30% we should be able to achieve. And once we have that number for the coming years, once we achieve that, once few initiatives what we have taken in place in terms of modern trade, export, EBOs and all, those are also contributing good and we have done good in those areas. Only the GT has been a problem. Once we have a support from GT as well, we are sure we will be able to achieve these numbers.
So the new machine, go ahead.
Sorry?
I think the new machinery and the investments that we have been doing and small debottlenecking that is happening. So the benefits of these will start coming from the next year onwards, or anything that you would like to share on that?
Start from this year only.
Okay.
The new export unit, what we have set and all, will help us in export, will help us in modern trade as well. So in coming quarters, it will start adding to the contribution.
Okay. For FOTL, we have this license agreement which was seeking an extension. So do you think you will extend it beyond 30th of June or how will that be?
It will all depend. We'll still try to negotiate on our terms and all. So if we have a favorable term, we'll try and negotiate and extend. All depends upon the negotiation what we are doing at the moment.
Okay, but there is no write-off that we should be expecting or some negative surprises from there because they are holding some inventory of around 11-12 crores. So that shouldn't come as a surprise to us, right?
So the idea is to liquidate that stock before we terminate anything. So, and all provision, everything is in place.
Yeah. So we are hopeful that we will be able to negotiate and renewal will be done. And inventory, all the inventories are in good condition and we'll be able to sell in the market.
Okay. Of these 5 subsidiaries that we have, Emoji Urban, Rupa Bangladesh, Rupa Fashion and Europe Fashion, which of these are absolutely PAT positive and which of these are probably at the break-even point for EBITDA levels?
We are not doing much activity into Rupa Fashion or anywhere because few initiatives we took before COVID, like Bangladesh and all is still on hold. But Emoji, we are PAT positive.
And Oban, we have also PAT positive.
Oban as well, we have PAT positive.
Okay. So a broader question which is related to the industry, probably at Tirupur cluster, and they had certain issues during the entire year as well as the industry. And currently, what is the situation with the export associated to knitwear? If you can take us through that.
The demand is still subdued, and the reason why the yarn prices are still soft. So once the demand picks up, then only Tripur does well, the export does well from Tripur. So the yarn prices will tell everything. When the demand comes up, yarn prices is a trend setter. So that is from the movement of yarn prices, one can make out how the export doing and how the export demand and all. So at the moment it is soft.
Okay, but then any hope that it will start picking up by maybe the thermal season or anything, any guidance that you'd like to give?
And difficult to comment on the export market, but domestic market, these are all essentials. So we are sure there are two types of demand. One is consumer demand and other is your trade demand. So last year trade demand was soft. So whatever stock they used to keep, I am sure they are not maintaining that kind of inventory. And once the market has some kind of firmness, I am sure the essentials should do well, should pick up. There is no reason it won't pick up. We don't see any reason.
Okay. Last two questions. One is related to the entire thesis that we had for Rupa and, try to look at premiumization of the brand and as the products that we have. By when do you think this will start kicking in?
So the process is on. We are opening EBOs and all. We have recently for our brands like Macroman M Series, we have endorsed this brand ambassador Yash, who's a very big star from South and all. And we have started the campaign. We are getting very good reviews. In other brands like Frontline, we have launched Frontline colors, where the MRP of the product is at least 20% higher than the current range. So we are introducing new range every quarter, every month. And EBOs, modern trade, as I have said, has contributed a better number from last year. So the process is on, and gradually it should reflect into numbers as well.
The last question being on the share for the women segment, which we thought that, just because of the pandemic, it went down. But then we were quite gung-ho on the entire segment or sub-segment of women, which is currently around 11 or 12%. So what are the efforts put in by the team to kind of increase this or, probably increase the volume from here, because this segment seems to be a slightly higher margin segment. So what are the efforts that are put in by the team to put an uptick over here and try to move this to around 15 or 20% of the total revenue?
Absolutely, it's very important for our company also to grow on the top line in the women's segment where we are not that strong so far. So we are investing into product lines, we are investing into team as well. And either it is online or EBOs, we have tried with opening few EBOs exclusively for women as well. And we are spending on the campaign with the celebrity Kiara Advani. And we are doing some retail types also, which will start this year in this quarter. So those things should help us. And our network is already there. We are trying to do something new with the campaign as well. So I'm sure these efforts will help us to, if not last year, this year should do better.
Okay, Vikasji, thank you for answering the question. Thanks a lot.
Thank you.
Thank you. We have our next question from the line of Vinay Mehta from AG Investment. Please go ahead.
Good evening, everyone, and thanks for this opportunity. So my question was on the distribution network part. So what is the plan to expand the distribution network from current levels? And let's say, next 3-4 years, where do you see this number to go?
Since we have untapped area, just like Madhya Pradesh, Chhattisgarh, portions of South, we have a total revenue contribution from the South India is 7%. So we are planning to set up a distribution base in South India. Currently, we have around 1,500 distributors. We are targeting around 2,000 distributors in next 2 years, 2 to 3 years.
Okay. And with regards to the EBO network, and a couple of quarters back, you had mentioned that you had a plan to add around 50 odd stores in FY23, and pan-India presence of around 150 EBOs in the next 2-3 years. So what's the situation like right now with regards to the EBOs?
As you mentioned, we have opened 2 new EBOs. At the same time, we have shut we have to shut 2 EBOs. So the current strength is 28 stores, and the plans were aggressive, but the market is a little soft now, which we can see, and the market is not so strong. So the franchisee at the moment is not very willing to open the EBOs. So we'll wait for a couple of months. But we have 2 stores in lineup. 4-5 stores will open in a month or 2. But once the market revives, slightly better demand is there, this number should improve.
Okay, cool. And one last question I had on the marketing budget part. Could you please throw some light on the marketing budget, and what kind of volume growth do we see in the next 2-3 years down the line?
So, like COVID year, our average was always 7 to 8% for marketing spend. COVID year it was 4%, but now again we will come back to 7 to 8% on the marketing spend.
Okay.
And volume growth, we are looking for at least 15% volume growth current year, 15 to 18%.
Okay, sir. Okay. Thanks a lot for your time, sir, and best of luck.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to management for closing comments. Over to you, sir.
Thank you everybody for joining the call. In case of any clarification and further information, please connect our IR partner, Mrs. Orient Capital. Thank you. Thank you so much.
Thank you everybody.
On behalf of Rupa and Company Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.